Good afternoon, Abby. I see that you've joined the call.
Good afternoon. How are you?
I'm doing well. So, with that, Abby, I'm going to stop sharing my screen here. And so today we have Abbey Omodunbi that's going to be speaking with us today about the 2021 economic outlook. So, Abbey is a assistant vice president and economist for PNC Financial Services Group. In this role, Abbey is responsible for contributing to PNC's regional, national, and international economic analysis and forecasts, including coverage of metropolitan area economies throughout PNC's footprint. In addition, Abbey also speaks frequently about the economy to PNC clients and regional media. Prior to joining PNC in October 2018, Abbey spent 3 years in risk management at Goldman Sachs in New York. He also worked as a summer research fellow at the Conference Board in New York. He is a member and past research director at the nonprofit FREE, which is Financial Requires Effective Education, and it's a financial literacy initiative. He's also a member of the Economic Club of Pittsburgh, the local chapter of the National Association of Business Economics. Abbey earned his PhD in economics from the State University of New York in Binghamton, with concentrations in labor economics and econometrics. He also has a Bachelor of Science in Mathematics from the New Jersey Institute of Technology. So, Abbey, if you want to go ahead and start sharing your screen, we'll go ahead and move forward. So, okay, great.
Sure.
I
Thanks.
can see it.
You
So
can
I'm
see it.
assuming
Okay.
everyone else can. Yep. So thank you
Thanks.
again, Abbey, for joining, and excited to hear what you have to say.
Sure. Thanks for having me back. It's a pleasure to be back. Last year, I did say we weren't going to have a recession in the next 2 years, but nobody could have anticipated a pandemic. Like nobody said this coming. So the U.S. economy fell into a recession in February last year. On the bright side of things, we've made a lot of economic progress since then, but we're still well below pre-pandemic levels of economic output. So here are my expectations for 2021. It's very likely that we get another stimulus package in the next couple of months. We've had several rounds of stimulus so far. We had the CARES Act, which was over 2 trillion in stimulus. We also had stimulus being passed in December. The stimulus included, the paycheck protection plans and paycheck protection programs, and also stimulus checks to consumers. So it's very likely that we get another one in the next few months. I also expect consumer spending and the housing market to continue to support economic growth this year. We're also going to see structural changes in different sectors. We're going to see the Amazon effects being accelerated due to this pandemic. We're also going to see structural changes in the commercial real estate sector. Our forecast calls for real GDP growth of around 0.3% in the first quarter of 2021. So it's going to be slow economic growth in this quarter. And we expect real GDP to return to pre-pandemic levels by the end of this year. So heading into this recession in February last year, consumers were in very good shape. So this chart shows you the financial obligations ratio as a percentage of after-tax income. And financial obligations includes mortgages, rents, your car notes, student loan payments, aggregating all those obligations as a percentage of after-tax income. And there are a few things I'd like to draw your attention to. Like coming into this recession, as you can see, we were at a much better level than pre the Great Recession. So financial obligations as a percentage of after-tax income was close to 18% pre-Great Recession, but it was closest to around 15% heading into February last year. So consumers were in very good shape. We also had very high personal savings rates. So the personal savings rate was much higher than it was pre-Great Recessions. So consumers had solid balance sheets. And again, this recession was caused by something outside the economy. So economic fundamentals were very strong, were very solid, but this was something outside the economy. It was a public health crisis, which eventually evolved into an economic crisis. And households were generally doing very well. This chart shows the change in real median household income. As you can see, the longer the expansion lasted, the better households did. So in 2019, the year-over-year change in the real median household income was close to 7%. So this means it wasn't just upper income and middle income households that were doing well. Like the median American was also doing very well. So consumers and households were in very good shape before the recession started last February. But business debt was more of a concern. So this chart shows the corporate debt as a percentage of GDP. As you can see, corporate debt levels were very high. It was closer to around 55% of real GDP before this recession started. But while that could have been concerning, interest payments were very low. So companies were doing very well. Companies had very solid P&L, and they were able to make their interest payments because interest rates were very low. Now, so recessions are usually caused by imbalances in an economy. Again, this recession in February last year was caused by an exogenous event, something outside the economy. So the National Bureau of Economic Research, they define what a recession is. Based on their definitions, these are the expansions we've had since 1933. As you can see, we were in the longest expansion before this recession started last February. So recessions are caused by imbalances. The recession in 2008 was caused by an imbalance in the subprime mortgage market. The recession in 2001 was caused by, the tech stock crash. So there was an increase in tech stock prices and eventually led to a bubble. The recession in 1991 was caused by the student loans crisis. There was a bubble in that sector. The double dip recession of the 1980s was caused by the Fed aggressively increasing interest rates and by double digits inflation. So looking at the economy before the pandemic started, none of these imbalances were present. So the housing sector was solid. Consumers had very solid balance sheets and so on. And then we saw the sharpest contraction on record. So this chart shows three different measures of economic output. And there are a few things I'd like to draw your attention to. First, as you can see, during the Great Recession, we lost about 4% in about 1.5 years. So the US economy was 4% smaller over a period of 1.5 years. Now compare that with the viral recession. We lost about 10% in 2 quarters. So in Q1 and Q2 last year, the US economy was 10% smaller than it was before the pandemic started. So 10% less goods and services were being produced in the US due to this pandemic. On the bright side of things, things have improved. As you can see, there was a sharp recovery in the third quarter of 2020, but the pace of recovery has stalled. So if you see the green and the blue lines here, recovery is flattened out, so it's slower. So the way forward is going to be very uneven. So we're going to see an uneven recovery going forward. And another indication of how of the current level we are is the labor market. So we lost about 22 million jobs in March and April last year. So looking at this, you can see again, we've made improvements, but then again, we're still well below pre-pandemic levels. And we actually lost jobs in December. We lost about 150,000 jobs in December. And this was mainly in the leisure and hospitality sector. And the leisure and hospitality sector lost jobs because the services sector has really bore the brunt of this recession. This recession really affected, congregate businesses, so retail, restaurants, and just the services sector in general. And there are a few things I'd like to draw your attention to. Over here, as you can see, we've made some progress, but we're still at basically 2015 level of jobs right now. So again, we've made a lot of progress, and things are heading in the right direction, but we're still well below the pre-pandemic level. And in many ways, the unemployment rate understates the level of unemployment in the US economy. And that's because so many people have left the labor force. So lots of folks have left the labor force because they're discouraged. Some left the labor force because of health concerns. Some folks don't feel comfortable going out to look for a job because we're still in a pandemic. Some folks are not in the labor force because they have to take care of their kids. As we've been working from home for close to a year now. I mean, I've been working from home for close to a year. I'm sure many of the folks listening to me right now have been working from home for close to a year now. You know, there people have had to take care of their kids, and some people have had to, drop out of the labor force because of this. So as you can see, this chart shows the employment to population ratio. So looking back at all the gains we've made since 1956, think about things that happened since 1956, the birth of the baby boomers, increase of women in the labor force. We lost all that in about, 2 months at the heights of this, at the peak of this recession. Again, we've made improvements, but we're still well below the pre-pandemic level. Another trend we've seen in the labor market has been an increase in permanent job losers. And this is concerning because it means there's likely to be a permanent structural damage to the labor market the longer this pandemic goes. So we've seen a decrease in unemployed, in temporary layoffs, and that's a good sign. It means folks who lost their jobs temporarily are either going back to the same jobs or they're getting permanent jobs. But the slow increase in permanent job losers is a concerning trend. Again, it means it's very likely that folks will lose their job permanently, they'll lose their skill sets, and again, they're likely to be longer permanent damages to the labor market. And one of the reasons why we've made so much progress from an economic standpoint has been because of the aggressive and substantial stimulus passed by Congress and the U.S. Treasury. So over $3 trillion in stimulus has been passed so far. There was the CARES Act, which is over $2 trillion in stimulus, and the stimulus was targeted at small and mid-sized businesses through the Paycheck Protection Program. This included grants and forgivable loans to small and mid-sized businesses if they met certain criteria. It also included multiple stimulus checks. So there have been 2 rounds of checks sent to consumers so far. There was also extended and expanded unemployment insurance. So unemployment insurance lasted for a longer period of time, and it included more money to the unemployed. The CARES Act also included aid to states. So many states have seen their revenue streams dried up, and one of the benefits of the stimulus has been many states have had that capital cushion from U.S. Treasury and the Congress, just to help them just keep going. But despite the fact that there has been aggressive stimulus passed so far, it's still extremely important for there to be additional stimulus being passed for U.S. consumers and also businesses. And this chart will show you why. So this chart shows you personal disposable income and consumer spending. So personal disposable income, as you can see, that increased in April, and this is atypical for recessions. Usually incomes go down during recessions, but again, because of the aggressive fiscal stimulus from U.S. Treasury and and Congress, consumers' personal disposable income actually went up during the viral recession. As the boost from the stimulus has been fading, income has been decreasing, but as you can see, we're still well above the pre-recession level, which is very good. Looking at consumer spending levels decreased in March and April last year because there was a national lockdown. Folks couldn't go out. Many restaurants were closed. As the restrictions have been relaxed, and now lots of folks are able to go out to an extent. We've seen an increase in consumer spending, but as you can see, we're still well below the pre-pandemic levels. So folks still can go to theaters, can go to theme parks. And one trend we've actually seen is there's been an increase in consumer spending on goods, while the spending on services has actually gone down the past year. So folks are buying more appliances, cars, and just lawnmowers and just goods, the purchase of goods have been going up in the past year, but the purchases on services has actually been going down. And this will remain the same until things get normal, until the vaccines get rolled out and a substantial part of the population gets the vaccines. Then folks are going to feel comfortable going out in public and congregating in public. And and hopefully there's additional stimulus, which is also going to boost consumer spending. So one of the bright spots in the last year has been the housing sector. So the residential housing sector has been making very strong gains in the past year. So consumer demand has held up because of record low mortgage rates. Mortgage rates are very attractive right now. They're less than 3%. Also due to just a demand for more space. So we're seeing lots of folks who live in condensed cities move to the suburbs. So this has also spurred a demand for more space. So this chart shows housing starts and also existing home sales. As you can see, in March, there was a decrease in housing starts during the pandemic, but we're back at the pre-pandemic level. On the other end, existing home sales has actually exceeded the pre-pandemic level. So our outlook for housing in 2021 is that house price growth is going to be solid, but it's going to be less than what we experienced in 2020. So the housing market is going to continue to lead the economic recovery in 2021. We've also seen healthy gains in the stock market. This chart shows you the returns from the S&P index and also the volatility index. As you can see, looking at where we were in 2015 to where we are now, the stock market has made very healthy gains. So, if you have a brokerage accounts, if you have 401ks or pensions, I'm sure, you've seen very healthy returns in the past year. We've actually exceeded the pre-pandemic level. And this has also contributed to the wealth effect. So upper income and middle income households feel wealthier now due to the gains in the stock market, and they have more capital to like buy a bigger house or, make purchases that they couldn't do pre-pandemic. So the stock market is a leading indicator, and it basically tells you what investors expect of company earnings. So investors have priced in a full recovery. Investors think that the U.S. economy is going to make a full recovery, and also company earnings are going to be solid. But the stock market is not the economy. The stock market and the economy are two different things. But again, it's a forward-looking indicator of what investors expect for company earnings going forward. So we saw two emergency Fed rate cuts. The Fed cut rates by 1.15% in March. This has caused 3-month Treasury bills and 10-year Treasury bonds to trade at record lows. So the 3-month Treasury bill basically is the yield at which the government borrows money from investors for 3 months. It's a short-term interest rate, while the 10-year Treasury bond is the rates at which the government borrows money from investors for about 10 years. It's a long-term interest rate, and it's usually benchmarks mortgage rates. So there's a strong positive correlation between the 10-year Treasury bond and mortgage rates. So we expect the yield curve to steepen in the next couple of years as economic growth picks up and as the Fed tapers quantitative easing. So quantitative easing is also another reason why we've seen record low 3-month Treasury bill rates and 10-year Treasury bond rates. So quantitative easing basically is when the U.S. government buys treasuries and mortgage-backed securities. So when the U.S. government buys the securities, the price of these securities go up, but the yields go down. So we've seen downward pressures on yield rates due to quantitative easing. We've also seen the Fed, like I said, pull out all the stops, just go all out to ensure that we get a full recovery, to ensure that we get back to where we were pre-pandemic. So this chart shows you the Fed's balance sheet. It includes treasury bills, mortgage-backed securities, and so on. So the Fed is going to continue its quantitative easing program until the economy gets close to to its pre-pandemic level. And whenever I present any of the previous two slides, one of the next questions I get is, should we worry about the budget deficit? My response to that will be, it's important for, the Fed and, Congress to pull out all the stops to ensure that we get back to the pre-pandemic level. Treasury yields are at record lows, so it costs the US government about 1% to borrow money for 10 years. And also, the US economy is in a much better place to deal with a budget deficit with a good economy compared to a bad economy. So it's better for us to get back to being a strong economy, and then the US government can deal with a budget deficit. So this chart shows you the conditions in early 2020 before the pandemic started. As you can see, there was solid broad-based growth all over the US. It wasn't just limited to the north or to the south. It was really broad-based all over the US. Economies were doing very good. Consumers had very solid balance sheets. Businesses were doing very good. Debt levels were, a bit high, but again, interest rate levels were low. So, businesses and consumers were generally in good shape in February 2020. And then things got really bad, due to the pandemic. Again, no state was spared, no country was spared. This was primarily a health crisis, which evolved into an economic crisis. This crisis really affected the services sector. Historically, recessions usually affect the manufacturing sector, but for this particular recession, mainly the services sector in various states in the US were affected by this. So just looking at where we are now, this is the most recent coincident index we have. It's from the Federal Reserve Bank of Philadelphia. It basically tells you the current conditions in different states all over the US. As you can see, the yellowish states are basically experiencing either contraction or slow economic growth, while the ones that are closer to blue are experiencing economic growth. As you can see, majority of the states around the US now are in much better shape than they were compared to where they were, say, in May. But we're still not at the pre-pandemic levels. So again, it's going to take a while for us to get back to the pre-pandemic level. So we're also likely to see an uptick in demand for crude oil in 2021 as consumers go out, as the vaccines are being rolled out and folks feel comfortable going out. There'll be a boost in the demand for crude oil. But on the other end, there's likely to be more regulations from the current administration when it comes to like the energy sector, because the current administration has been proposing various green and clean energy initiatives, and this is likely to affect the already weak shale and gas industry. So we're likely to see structural changes in so many different industries. We're going to see the Amazon effects being accelerated. So the Amazon effect is the increase in brick and mortar, the reduction in brick and mortar retail, and the increase in online sales. So stores like Amazon and Target online, folks that basically participate in e-commerce are going to see an increase in the market share, while we're going to see a decrease in retail. So our view is that that's going to get accelerated due to this pandemic. We're also going to see changes in the commercial real estate sector. Lots of folks are working from home. I've been working from home for close to a year now. I'm sure lots of you have been too. This is likely to cause a reduction in the demand for commercial real estate space. And we're likely to see, structural changes in this sector going forward. But those structural changes will be dependent on, how flexible companies are once the pandemic ends. So are companies still going to want a majority of their workers to work from home once the pandemic ends? So that remains to be seen. If that trend remains the same, or if it increases, then we're likely to see a reduction in the commercial real estate sector. On the other hand, we've seen an increase in data centers and self-storage. And again, that's because lots of folks have been working from home. Lots of folks have been making purchases online, the Amazon effect and things like that. So we've seen increase in returns in data center and self-storage REITs. So the Fed has a dual mandate. So the first mandate is maximum employment. The second mandate is price stability. We expect inflation to pick up as folks start going out and there's an increase in the demand for goods and services. But we don't expect inflation to exceed the Fed's target of 2% in 2021. And that's because, as it is right now, lots of producers, lots of companies don't have pricing power. Think about airlines, for example. Airlines can't really increase prices right now because folks aren't flying, and also demand hasn't really gone back to the pre-pandemic level. And even before the pandemic started, low inflation was something the Fed had been saying over time. And our view is that inflation is going to stay below the Fed's 2% target in 2021. So our forecast calls for slow growth in the first quarter. The slow growth is going to be due to the resurgence in cases. There's been imposing of restrictions in many cities and states. It's been more targeted than it was last year, but still that's going to reduce economic activity in the first quarter. So we expect growth of about 0.3% in the first quarter of this year, and we expect the economy to return back to its pre-pandemic level by the end of this year. In the labor market, it's going to take longer for the labor market to return to its pre-pandemic level. So the unemployment rate went up to close to 14%. Right now, it's at about 6%. Again, the unemployment rate doesn't really give the full scope of the state of the labor market because so many folks have left the labor force, and it's going to take a couple of years for those folks to come back into the labor force. And our view is that the unemployment rate is going to return to its pre-pandemic level in 2024. As you can see, these are projections. The broken lines are our projection. As you can see, the unemployment rate doesn't return back to its pre-pandemic level at the end of 2022. So it's going to take till at least 2024 for the unemployment rate to return back to its pre-pandemic level. So here are my expectations going forward. Again, it's very likely that we get another stimulus package in the next few months. The stimulus that has been passed in the last year has been very helpful. It's been a boost to the U.S. economy. But again, there's still so many people out of jobs. The airline industry, the restaurants, hotels. So many sectors are still struggling. Especially folks, part-time workers and folks that are frontline workers. Many of those folks are still struggling right now. I also expect consumer spending and the housing market to support growth in 2021. Consumer spending is 70% of U.S. GDP, so that is going to continue to support economic growth in 2021. We're going to see structural changes in retail and the commercial real estate sector. We're also going to see supply chains being disrupted. So lots of folks who relied on one country for their raw materials are going to have to diversify their supply chain. So they're going to, now, think about going to 3 or 4, even more different countries to get their raw materials. We're also going to see some companies bring their supply chains home. So some companies that were depending on, say a Japan or a Thailand or a Vietnam, will now bring some of those raw materials back home and, just diversify their supply chains. Lastly, our real GDP forecast is for slow growth in the first quarter, and we expect economic growth to pick up in spring once the vaccines are rolled out and folks feel comfortable going out to, buy things and congregate in public. And there's going to be a lot of pent-up demand being unleashed by consumers because folks have been basically cooped in and confined for so long. So once folks feel comfortable going out, we're going to see an increase in consumer demand, and we're going to see an increase in consumer spending, and we're going to see strong economic growth from spring. So our forecast is that real GDP will return back to its pre-recession level at the end of 2021. So thank you so much. We have economic reports on our website, pnc.com/economic reports. I'm happy to answer any questions.
Great. Thank you so much, Abby. So yeah, at this time, we'll open the floor up for any questions.
Hey, Drew, this is Gary. Abby, thanks for the presentation, very informative. I just was curious about, I guess, deficit created by the stimulus packages, and what do you see as the impact of that, I guess, going forward? You said, I don't think you said inflation was going to, increase that much, but is it possible with tax increases or things like that from the deficit perspective at the federal level?
Right. So it is important for Congress and Treasury to go all out now. I think the risks of doing too little are more than the risks of doing too much. In terms of the potential effects of the deficits, it's very unlikely that we see inflationary pressures from added fiscal stimulus, from additional fiscal stimulus. And that's because there are structural forces that have kept inflation low for so many years, and that was the trend even before this pandemic started. One of the forces has been globalization. Globalization has improved over time. Folks rely in different countries for the production of goods and services, and that has had decreased effects on prices. So there are other factors like demographics and technology innovation and so on that has kept inflation low. So even if there is additional stimulus, our expectation is that it's very likely that there will be additional stimulus in the next month. It's unlikely to cause inflationary pressures. Does that answer your question?
Yes, thank you.
Thank you.
Abby, I got a question. I know you touched on the crude oil market a little bit, and I was wondering if you could touch on the global impact of anything that's going on that's affecting the crude oil.
Right. So again, because this was a global pandemic, right? So we saw crude oil prices get negative last year, right? But that was a storage issue. That was a supply issue. But so there was a decline in crude oil prices, but as vaccinations are being rolled out globally, we're going to see an increase in demand for crude oil this year. Also depends on what OPEC Plus does, right? If there are supply cuts and things like that, but as the global economy improves, that's going to increase the demand for crude oil, and we should see a pickup in the demand and pick up in crude oil prices in 2021.
Well, what about natural gas? It used to be kind of tied to the crude oil price, but I guess in the last 5 to 10 years, it became more separate. What do you see on the natural gas side? And then I guess second question is on the clean energy side. What are you seeing in terms of those industries and markets?
Right. So first, natural gas. As you said, it's been disentangled from the crude oil side of things in recent years. So there will be an increase in demand in the short term. I don't foresee there being as strong as an increase in demand in natural gas as there will be in crude oil in 2021. And then about the clean and green energy initiatives, so that's going to take a while, right? So it takes a while for policies to be passed, and there might also be some legal challenges, right? Because this is going to affect the whole sector, so I don't expect things to just happen that quickly in terms of the move from fossil fuel energy into cleaner and greener energy. In the long term, there's likely to be a small drag on economic growth if that transition is successful, but I expect businesses to readjust and to be able to basically just manage the new policies. So I got it. Sorry, does that answer your question, Gary? Or did you want to speak?
Yes, sir. Yes. No, that's good. Thank you.
Right. Yeah. So I got a question saying, what economic sectors will have permanent damage as a result of the pandemic? I think one of the sectors that's going to be damaged permanently is the retail sector. So I think this pandemic has really accelerated the Amazon effect, which is just purchasing things online. Like, most folks haven't been to a mall or to the store in a while. I mean, most folks have had to stay indoors, so there's likely to be a lasting damage to the retail sector. I think we're also going to see that, there will be, it will take a while for us to get back to the level of comfort which we had in terms of just congregating around. So I don't foresee people just like being too quick, wanting to just go too quick to like a theme park or like a theater or something. I think there'll be a few reservations. So it's going to take a while for the services sector in many states to get back to its pre-pandemic level. Again, people will need to feel comfortable from a health perspective first before things get back to where it was pre-pandemic. Someone said, could you comment on why this? Sorry, did you say something, Drew?
No, I think I think you were about to read the same thing I saw about the the comment that came in on the chat. Yeah.
Right. So someone asked about the stock market, like, why has the stock market been doing well during the past months? So I mean, I guess you could say to an extent there is a disconnect between the stock market performance and the U.S. economy performance. The U.S. economy's recovery has stalled. It's slowed down in recent months, especially with the resurgence of the virus. But then, the stock market is not the U.S. economy, right? So the stock market is basically investors looking forward as to what they expect for company earnings. I mean, I think one of the reasons why the stock market has done so well in the past year has been because there's so much liquidity, right? So I mean, the Fed reduced interest rates to record low levels, and folks' personal disposable income increased, which is atypical for a recession. And folks really haven't had places to go, right? Because there's so many restrictions. So personal disposable income has increased due to the stimulus checks. There have been 2 rounds of stimulus checks now. There's also been extended and expanded unemployment benefits, and also there's also been an increase in retail investors, right? So investing used to be this opaque thing in the past, but now it's basically lots of barriers have been broken, and we're seeing an increase in retail investors. I believe that has also contributed to the strong performance in the stock market in the past year.
Any other questions? I'm sorry, I guess I was muted that whole time. I was just saying that I didn't see any other questions come in via chat. So thank you, Abby, for your time and insight on this topic. And for everyone on the call, take care and stay safe out there.
Thank you so much. Thank you, everyone.
Thank you. Have a great day.
Okay. Thank you, guys. Bye.
Bye.